Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we touched the all-time highs on the 1-hour chart. We slowly dipped into negative MACD, however over the morning we went up to positive MACD, and as for the 4-hour chart we continue to point downwards as we saw a divergence back in December 17th in the morning, but we may see a possible convergence. And on the daily chart, we start to see a convergence that was made back in December 12th, and we are also overbought on the daily RSI. So at the moment, since we touched the all-time highs today of $321.97, when could mark the next possible support. I do see a possible support that range around the price of $315.55. Reason why we have the 18-day moving average, this purple line, and there is resistance that date back to November 27th and December 9th and 10th. So since we are above that resistance price, that acts as our support. So we do have that support. And as for resistance, the all-time high is going to be our resistance. And if we were to move down lower, that price movement is roughly around 1.8% to the downside. So the forecast model is now available in the link below for the S&P 500. If you configure the settings, you'll get all the results in this video. You get the models that I do not go over in the video, so do check it out. Again, it's in the link below. So back to the day-by-day probability model. What we have here, we have a high concentration that the S&P 500 will range down 3% down and above 3%. So there's a good chance that we remain in this standard deviation. We do not see any chances of, say, 6 to 3% down. Same thing with 3 to 6% up. However, we see one possible chance that we may see 6 to 10% down, but that is highly unlikely. There's a 7% chance in the next coming days or in 1 week. So again, I do bet on the S&P 500 will remain between negative 3% and above 3%. So where do these models come from? The models come from the forecast model. So I'll go day by day where the S&P 500 will head to next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is the best match to the current trend. Right here we have the current trend, and below is the trend that I believe is the best match. This trend dates back to December 10th, 2012 to March 8th, 2013. So let me point out why these two charts are similar. So what we have here in the beginning of the trend, we touched the bottom Bollinger Band, and then we proceeded in a uptrend averaging above the middle Bollinger Band for several days or even weeks. We have that point there. Next, we took a slight dip below the middle Bollinger Band at this instance, and then we proceeded to continue on and touch the upper Bollinger Band right towards the end. So on the trend in question, we start to see a similar pattern as well. We start off touching the bottom Bollinger Band, and then after touching the bottom Bollinger Band, we proceeded to average above the middle Bollinger Band. After averaging, we see it take a slight dip below the middle Bollinger Band right here, and then afterwards we finally see it touch the upper Bollinger Band, just like the current trend. So what we have is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe if the trends and patterns are the same, the outcome and forecast should be fairly the same. So the model that we just examined was December 12, 2012 to March 12, 2013, or March 8th, I should say. And back then, the S&P 500 was down roughly around, I would say, 55 basis points. So not much to the downside. So overall, we may even touch on to the support level or the 18-day moving average as indicated in the technical analysis. So again, this forecast model is now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.